talk about underperformers and outperformers. One thing that the Nifty and the Sensex don't have, there are significant outperformers oftentimes in the market are mid-cap stocks. So surely by adding mid-cap stocks, investors can get an edge on the index.
That's right. See, by definition and by design, Sensex and Nifty represent the top 30 stocks. Not the absolute highest number, but 30 good companies which are large cap stocks. But then you have mid cap indices as well, and you have small cap indices as well. But look, the investor is not fixated on the size of the company. His objective is to get the maximum returns. And the highest returns historically over 50, 100 years has come from mid-cap and small-cap stocks. Obviously, because the size is small, they can grow faster. The faster you grow, the higher returns you can generate. So therefore, from an investor's perspective, it is important to have a fair proportion of small and mid-cap stocks as well, so that your overall portfolio return can beat the Sensex and Nifty or any other benchmark that you're looking at. Nowadays, we get indices which have 500 companies, like Nifty 500, which has got large cap, small cap, mid cap, all of them are interspersed in it. So from an investor's perspective, he can certainly add a few select mid-cap stocks to get the alpha on his return.
So I'd like to learn, from your experience here. You've been a mid-cap investor for a very long time. How did you come to this learning, and how is investing in mid-caps played out for you, and how has it affected your portfolio returns?
So I think mid-caps are really the cream which creates the outperformance. Large cap stocks are good, safe companies, and they grow at a steady pace and provide you steady returns in line with the Sensex and Nifty. But it's the mid caps which give you that additional 3-4% flip in your portfolio returns. And if you've got the right mid cap stocks in your portfolio, then that portfolio will do exceptionally well. But before we get into that, Varun, I think it's important for the viewers to know the proportion of mid-cap stocks in their portfolio as well. And that's a very important lesson, because you could get carried away and put 100% of your investment in mid-caps. But then when the economy does badly or there's a bear market, then your portfolio will unnecessarily be hugely underperforming and you may actually have loss of capital. So balance is important, and I think we should talk about that.
So all of this is great, right? It's great to know the theory, but why don't you tell us with an example from your own investing journey?
See, normally in my investing style, I don't invest more than 1% in a single stock, be it mid-cap. If it's a mid-cap stock, 1%, large cap stock, 3%. So like I bought Bajaj Finance at around 170 rupees about 10, 12 years ago or so. And that's gone out to about 7,000 rupees just now. And it was just 1% when I bought it. But now, because it has appreciated the way it has, it is like 15% of my portfolio. Same is true for Tata Elxsi as well. That's also been almost a 50 bagger for me. And I've seen many investor portfolios where 0.5%, 1% invested in a small mid-cap stock over a period of 5-10 years grows so large that becomes a large portion of their portfolio and really is driven the returns for that particular portfolio. So my advice would be that select 4 or 5 good quality mid-cap stocks in your portfolio, invest 1% in them, and have a limit that you'll do maybe 5%, 10% of your portfolio in mid-cap stock. And I'm talking about conservative investors who are not hands-on traders. And if those stocks have really are really good quality stocks and they have what it takes to be multi-baggers, then it's just about enough. In a few years, you will see that these mid-cap stocks have become large-cap stocks and part of the index, and they have a very large weightage in your own portfolio as well.
This podcast is produced by Elxsi Equities Private Limited, a SEBI registered research analyst. Registration number INA 0000004787. The information provided in this podcast is for educational and informational purposes only and should not be considered as investment advice. Investment in securities market are subject to market risk. We strongly advise all investors to read all related documents carefully before investing.